There's a massive universe of stocks out there, and sifting through that pile of stocks to find the ones for your portfolio can be daunting, especially if you're new to stock picking or you're unsure what metrics matter and what don't. You will find different ideas of what constitute the best metrics from every source that you find. It's no different on the Quality Investor, but I want to focus on a single metric that you can use as a starting point, but not by showing you individual stocks. We're looking at the bigger picture, and that metric is return on invested capital. Welcome to the Quality Investor. ROIC is one of the best metrics, in my opinion. This one number tells you so much about a business. It's a proxy for management's ability to allocate capital. It approximates what kind of overall return to expect, and it can be used to achieve certain growth targets while maximizing free cash flow for investors. More on that in a bit. First, a definition. Return on invested capital is defined as net operating profit after taxes, or NOPAT, divided by total invested capital. NOPAT is best thought of as the income from the core operations of a business after taking out taxes. Note that interest expense is not deducted from NOPAT. Neither are things like investment income, if it's not an investing firm, and other things that are outside the core operations of a business. Also, depreciation expense is included in the operating expenses, but amortization is not. Once you have that number, you apply appropriate tax rate to account for the taxes. NOPAT. Before continuing, please remember to like this video and subscribe to the channel so you can stay on top of all the quality businesses in the market. Invested capital is all the monies invested into the core operations of a business. Very simply, it is the net operational working capital plus the property, plant, and equipment net of depreciation. Other definitions are something like equity plus total debt for invested capital, but I actually don't like that formula, mainly because debt can be used for things that aren't actually operational, like share buybacks or even dividend payments. Those uses of capital do not affect the core operations of a business. Further, our definition of invested capital does not include goodwill. Goodwill is recorded when a business buys another business at a premium. That premium is goodwill. If debt is used to finance the acquisition, goodwill is overstating capital in the core operations. So we have our basic definition. ROIC is NOPAT over invested capital. On today's video, I want to focus on sectors and industries that have the highest ROIC rather than individual businesses. This is a fast way to whittle down a large universe of stocks to a group of businesses that offer the highest potential return for investors. If we know what industries are the best at allocating capital, we can eliminate large swaths of businesses that will underperform the market or return average at best. It also gives context to where the best opportunities lie in an economy that is evolving at a pace faster than ever. Before looking at the numbers, I said earlier that ROIC can be used to achieve certain growth targets. How is this? Well, growth equals ROIC times your investment rate. Let's say a business has 40% ROIC, which is very good, by the way, and that business wants to grow at 10% per year. To do that, the business will have to reinvest 25% of its NOPAT back into the business. That 25% will be recorded as a capital expenditure. All businesses need to reinvest to grow, but some businesses can reinvest less money and still grow at a fast 10% clip. That's why understanding ROIC is so vital. A business with a 40% ROIC is returning 40 cents on every dollar of investment. Therefore, 40% multiplied by 25% reinvestment should ensure 10% future growth. Let's look at this example here. Business A has a NOPAT of $1 million, the same as Business B. Business A also has $2.5 million in invested capital. However, Business B has $5 million in invested capital. Therefore, the ROIC for Business A is 40%, whereas it's only 20% for Business B. NOPAT over invested capital. Each of them want to target 10% growth. So using our formula, ROIC times reinvestment rate equals growth, we can solve for our reinvestment rates for that target growth. It comes out to 25% reinvestment for Business A and 50% reinvestment for Business B. That means the CapEx spend for Business A will ultimately be $250,000 or $1 million of NOPAT multiplied by the 25% reinvestment and the CapEx spend for business B, it's going to have to be $500,000 or 1 million multiplied by 50%. So if business B wants to achieve that 10% target growth, it has to reinvest twice as much money because it has twice as less ROIC. Therefore, the cash flow left over for each business, the money that comes into the pockets of investors, is $750,000 for business A, but only $500,000 for business B. So a higher ROIC business will need less capital to grow in the future, thus leaving more money to us, the shareholders. That is ultimately what leads to higher than market rate returns in the long run. All right, with the relationship between ROIC and growth out of the way, what are these sectors and industries generating these high returns for investors? So what are we looking at here? So on the top here, this chart is the weighted average rolling 3-year ROIC by sector. And then over here, we have the weighted average rolling 3-year ROIC by industry. And then down here, I have a list of all the businesses that make up each of these categories. So what I did was I calculated a rolling average ROIC for every single business individually based on a 1, 3, 5, and 10-year period. So with a rolling 3-year, that means I'm using the last 3 years of ROIC and averaging that together. And then collectively, I took their market caps and weighted each business based on their market cap over the total market cap for their industry, their sector, and for the S&P 500. Right now, we're looking at all the S&P 500 businesses. So this is the market cap percent weight right now. I also removed any businesses that were in the banking industry or the insurance industry since the ROIC doesn't actually apply to those businesses. So looking at the sectors up here, so the best sector over the last 3 years has been technology, followed by financial services, followed by communication services. The worst sector has been utilities with only a 0.5% ROIC, followed by real estate at a 3.82% ROIC, and basic materials with a 5% ROIC. And to me, this makes sense. Utilities is a highly regulated industry, and due to those regulations, their returns are actually capped by the government. Real estate does not include REITs, by the way, it's just real estate services companies. But basic materials, those are commodities, basically. So they're competing on price and thus will ultimately have lower returns. Some other things I want to point out. So just because industrials is towards the bottom of this list at just under a 10%, it doesn't mean every industry within industrials is a bad industry. Over on the industry chart here, I have each industry ranked here by their ROIC. The highest is consumer electronics at 54.5%. Now, I will say that this is the S&P 500 companies only, and Apple makes up a large part of consumer electronics, so it is going to be a little bit skewed there. But in general, this gives a good idea of the best industries for ROIC. If we whittle down just to the industrials, like I was saying earlier, we can see the staffing and employment has a 32% ROIC. This will include companies such as ADP, Robert Half, and Paychex. This is followed by integrated freight and logistics, pollution and treatment, which I believe only has one company in the S&P 500, and industrial and distribution. Just looking in the industrial distribution category, we can see that's made up of Fastenal, Pool, and W. Grainger. All very good businesses. So using this weighted average ROIC here, we can get a very good idea of what industries have excellent capital allocation. Looking in the technology sector, one of my favorite sectors, consumer electronics, like I said before, which includes Apple, is the highest, but that's followed by semiconductors and software infrastructure. And then right after that, we actually have semiconductor equipment firms. And this really makes sense to me because these are all very high margin industries. They also don't have very high capital requirements. High margins combined with low capital requirements equates to high ROIC. If we look at just the semiconductors, we can see, of course, NVIDIA leads the way with an ROIC of 37%. You can see in general, the semiconductors also have just a very high ROIC businesses within the S&P 500. Texas Instruments is up there, Qualcomm, Monolithic Power Systems. So what makes up some of these worst performing sectors here? Let's look at utilities. You can see the best performing utilities are the regulated electricity, but that's only 3%. And the worst is right now, renewables, a negative 12% ROIC. Within basic materials, steel is actually a pretty well-performing industry at over 17% ROIC. But you can see the more commoditized the industry gets, the worse the ROIC. Energy is a very cyclical sector. So in some years, you're going to have the industries that have a very high ROIC, but then other years, you're going to be very low ROIC. So in the past 3 years, this is what we're looking at in terms of energy industries and their ROIC. But we can see that comes down a little bit when we look at it over a 10-year rolling ROIC, from 8% down to 3.36% for the sector. And none of the industries are over 10%. Another sector that I have some holdings in is the consumer defensive, specifically Costco. Now, Costco's in the discount store, and that has a 12.6% ROIC over the last 3 years. The highest performing is tobacco at a 21% ROIC. Both Philip Morris and Altria are favorites of the dividend investor community. However, despite tobacco's high performance, the returns have been very average or even below average over the last few years. I think that's part of the social stigma around tobacco. But you also have things like household and personal, which would be Procter & Gamble, and beverages, non-alcoholic specifically, like Monster, Coca-Cola, Pepsi. All of those have been very high performers, with the exception of Coca-Cola. But as you get to the bottom of the list here, you can see the more commoditized types of industries within consumer defensive, grocery stores, and then highly regulated industries such as the alcohol industry. Now, I mentioned communication services, but that's heavily weighted by the internet content information. That, of course, is Meta and Google. Their large market caps are really skewing these averages. Communication services as a whole is actually not a very good industry. Entertainment includes businesses such as Netflix, which is actually a high performer, but you also have Paramount Global, Walt Disney, Warner Brothers. All of those businesses right now are really in a battle over the streaming wars. Another industry within ROIC that tends to be a favorite in the dividend community is the telecom services, but I believe they're value traps. They're Verizon, Comcast, Charter, T-Mobile, AT&T. All of those businesses seem like they're always undervalued. But again, they're commodities, and there's a lot of switching between the various businesses for things like cable and cell phone plans. If we look at the financial services, we can see that's made up of credit services and financial data and stock exchanges. Credit services is probably one of the best industries to be in as an investor. The two big ones there are, of course, MasterCard and Visa. Both those businesses are incredibly high margin businesses, and they have incredibly wide moats. You can see that MasterCard's ROIC is actually almost twice as good as Visa's at 47%. And then within the financial data and stock exchanges, that's going to include businesses such as MSCI, FactSet, Moody's, S&P Global. Each of these have very wide moats. They offer services that really can't be duplicated, so there's high barriers to entry, and they all have monopolistic tendencies. So the financial services, in my opinion, is a very good industry to invest in, along with the top players in the technology, software, and semiconductors. So in general, your best performing industries are going to be staffing, employment, home improvement, which is Lowe's and Home Depot, medical distribution, credit services, semiconductors. You can see integrated freight and logistics is up there. Restaurants, also a very popular industry. All of these have businesses very necessary to our economy, but are also dominated by a few very large players, which creates very large moats. And at the bottom, you're going to see all the commoditized industries. Utilities are all down here, building materials, airlines is one that's very commoditized and highly regulated. But in general, this is just a high-level look at where the best returns are currently offered in the economy. So if you're looking for high-quality businesses, start with high-quality sectors: financial services, technology, and then, of course, your consumer defensive and consumer cyclical. In these sectors, you're going to have your most differentiation as well as the companies with the widest economic moats. Anything after that, you're getting more and more into a commodity territory or highly regulated industries by the government, and those are always going to offer subpar returns. So with that, what are some of your favorite industries to invest in? I would love to know. Please let me know in the comments below. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.